Most people have no idea where to start when it comes to investing. Should you buy property? Should you buy stocks? Should you buy crypto? The decision is so overwhelming. And the truth is, if you don't know how the main asset classes work, you might already be taking on way more risk than you realize. I'm Nisha, a former investment banker turned financial educator, and in this video, I'm going to be breaking down the main asset classes in plain English. For each one, we'll cover how it works, the real risk involved, what returns you can reasonably expect, how quickly you can get your money back out, and the time horizon you need to focus for each one. By the way, if you're watching this before the 11th of January, you might be interested in a completely free investing workshop that I'm hosting on Sunday. We cover how to invest and what to invest in, how to accelerate the returns on your investments over time, the single biggest mistake new investors make and how to avoid it, how to calculate what your freedom number is, and what you need to eventually live off your investments, and so much more. You can sign up at nisha.me, invest or click the link in the description below, and reserve your spot before doors close. Let's get into the video. So, let's start with what is an asset class? You've probably heard people talk about the importance of diversifying your investments across asset classes. But what does that actually mean? When I first started investing, I used to hear terms like equities, real assets, fixed income, and honestly, it all sounded a bit intimidating, like there was this secret language only finance professionals understood. But in reality, an asset class is just a category of investment, a bit like food groups. So if you could think of cash as your fruit and vegetables, think of your property. That could be bread, think of stocks, it could be milk and dairy. Each asset category has its own level of risk and potential return and purpose inside of your portfolio. Some will help your wealth grow, others protect what you've built, and a few are there to balance things out when markets get messy. It might even help to think of your investment portfolio like a meal made from a wide range of ingredients, from a variety of food groups. It's not a one-size-fits-all kind of thing, thought. It can take a while to figure out what's right for you, your situation, and your risk tolerance. And the best asset class for you might actually be very different to the best asset class for a friend. So, now you know what asset classes are. Let's look at the first investment option, and arguably the most simple, and that is cash. Cash is the safest asset as it gives you security. You know exactly how much you have. You know you can access it whenever you need. And that is why it is so important for short-term goals, like booking a holiday, like paying for a home repair, like saving for a house deposit in the next year or two, like covering an unexpected bill. There is a downside though, because although people tend to think of cash as risk-free, that is not completely true. There's no risk of losing money like you would when buying stocks or crypto, sure. But there is a risk that the value of your money will be quietly eroded by inflation. And that's because even if you earn interest on your savings, inflation will usually rise faster in the long run, meaning whatever you put in cash today won't go as far or pay for as much in 10 years' time. For example, if inflation is 5% and your savings account pays 3% interest, your money is actually losing 2% of its real value every year. So although the cash plays a crucial role in your portfolio, as it gives you the stability to explore the other asset classes without losing it all, you could watch this video about what I'll do if I start investing from scratch, which goes into what I'm saying there in a bit more detail. So although cash plays a really crucial role in your portfolio, it is not a great long-term wealth builder. So knowing this, how much cash should you actually hold? For most people, aim for around 3 to 6 months of living expenses in an emergency fund. Enough to give you peace of mind, but not so much that it slows down your growth. Once that's covered, the rest of your money can start working harder in other places, which brings us into the next investment option. So, first, let's add this to our table. So, the risk of holding cash is very low, and the returns are usually around 2 to 5% a year, if you're putting into a high-interest or high-yield savings account. The liquidity, that is to say, how quickly can you take out? Usually instant. Most of the time, you can withdraw or spend your money straight away unless it's in a fixed-rate account or something similar where you have to give notice. Last but not least, it's best suited for short-term goals like emergencies or saving for something ideally in the next 5 years. Now, let's move on to individual stocks. If you invested 1,000 inches Apple stock 20 years ago, it would be worth $130,000 today. When we hear success stories like this, it's so easy to see why equities, that's the asset class that stocks fall under, are so popular. When you buy individual stocks, you're buying tiny pieces of real companies like Nvidia, like Tesla, like Unilever. You become a part owner, which means if the company grows and earns more money, your shares also increase in value. Some companies, they also pay out a portion of their profits to shareholders through dividends, giving you a small income on top of potential growth. The average stock market returns about 7 to 10% per year over the long term, but that figure reflects hundreds of companies. The success of individual stocks, on the other hand, that can vary massively. One might jump up 50% a year, while another falls to zero. Even popular companies can go out of business, potentially leaving you with nothing. So, if you invested 1,000 inches Blockbuster in the 90 seconds and didn't sell before the company got into trouble, you'd probably wish you'd chosen a different stock, even though it is very hard to know which will be the winners and losers without a crystal ball. That is why most people only buy individual stocks after they've already built a very solid base of diversified investments, like index funds, which I'll explain in just a moment, using one of my favorite analogies. But first, individual stocks can grow your wealth faster if you pick well, but they can also wipe out your gains if you don't. They're best treated as a small, higher-risk portion of your portfolio. So think of them as something for long-term growth, but not for your financial foundation. So let's have a look at the table again. With individual stocks, the risk is higher because you're relying on the success of individual companies. The returns can be anywhere from 0 to 50% or more depending on how well you pick. But there's also a risk of negative returns, meaning you lose money. They're highly liquid since you can buy and sell easily, but they're best for a long-term horizon, at least 10 years, I would say.